All right, welcome everybody to the Sinclair Range Weekend Review, October 10, 2025. Normally, this is where I say, hey, let's wait for people to join. But I'm not saying that this week because it is not a live stream. We are pre-recording this because the internet is dead. I have every major Canadian carrier, cell phone, internet provider that exists coming into this house, and none of them are working right now. That's never happened before. Normally my internet's great. Not today, so I'm going to pre-record this up and pre-record this and load it up for you whenever we can. Also, I missed the show last week, and last week I was in Toronto. It was a very long trip for me. It's a long way for me just to get to Toronto, to the east where our office is. It's about 12 hours of travel time from where I sit right now, no matter what I do. And when I'm there, I'm back-to-back in meetings and dinners and drinks. I got stuff blowing up in the West at the same time. One client went into receivership. I'll talk about that shortly. We had new clients coming in. One of those new clients was just blowing up last week with complexity and fraud and all sorts of stuff. So that was a hectic week last week, and I got back in time specifically to do the weekend review show for you. And then we had technical problems, and here I'm having technical problems again. But nonetheless, we'll pre-record this, and hopefully we'll be able to upload it shortly at some point, upload it here at some point in the near future. So let's get at it. Welcome to a weekend review at Sinclair Range. My name is Scott Sinclair. I am founder and president of Sinclair Range, and the mission here on this show is to provide you some insight into what's going on every single week at Sinclair Range. It's a window. It's a window into deals, decisions, day-to-day adventures, and things that we're dealing with at Sinclair Range. We try to break it into segments, not always, but often we try to break it into segments, lessons learned for the week, interesting file or deal of the week, struggles of the week, my observations for the week. And so that's what we're doing here. Let's dive into it. In the last week, Sinclair Range, at my insistence, resigned from a client mandate, which almost never happens in 35 years or some really, really long period of time that I've been doing this business. Rarely do we end up resigning from a client mandate, but we had to do that this week, and it's not out of it's not out of dislike for the people or discomfort with what's going on. It's just that we find ourselves in a position where we can't add value because we're not being integrated into the team, and we usually work on a monthly work fee, success fees, other bells and whistles, but we don't track hours here. At Sinclair Range, we charge a fixed fee per month, almost always. Sometimes we charge hours if the client insists, but it's normally a monthly work fee. And so if you're not adding value, you're just setting off invoices for doing nothing, which is not a good place to be in. So I guess we didn't technically resign. We put it on pause was the language I used. This is a startup, this client, and they're really good guys. It's a partnership. I like both of them. And they're interesting deal people. They come out of the financial and promotion industries. And, we made great materials for them and was effectively running a back office, if we could put it that way. Materials being a pitch deck, a confidential information memorandum, models, all of the data rooms so that they could raise money and be credible with the information to go off and do that process. And throughout the course of preparing all these materials, which I think the firm did a great job on that, and so I'm proud of it. And because these are deal guys, they'll be like, oh, we got a term sheet on this deal. Oh, wait, forget that one. We got a term sheet at this deal. And every time we have to redo everything effectively. And so that was going on forever, but we got everything complete, and it's in pretty good shape. But they went off to do something else, and the communication seems to have broken down. And so I said, hey, we're just going to back off from this. We're going to pause. If you need us to update anything, just let us know. We're happy to do that for you and, help at any time. But it's disappointing. It doesn't feel like success, if I can put it that way. It doesn't feel like failure. Hopefully they're off getting things done. As I said, I really like these two guys, so I'm not trying to I'm not going to give you any more details, and we wish them nothing but success, and 100% will be here to support them when and if they want to come around. You can't all be deal guys. Every company, if you're in business and you're an owner, manager, an entrepreneur listening to this content, which I know many of you are, you can't just be deal guys, but every company should have a deal guy. But you also need operations. You need management. You need to keep your head down and create value. It's great to start a company, to do a launch through acquisition, which was this client's plan, of various things, put them together, get the synergy, be vertically integrated. That's all good stuff. But someone has to actually execute on this, start generating revenue and doing something tangible. And you can't be weighted too far in the deal-making direction. You can't be weighted too far in the execution direction and have no finance function or deal-making ability. That's also a problem, right? You have to have both of those functions going on. I had 2 conversations this week, in fact, with parties that, how am I going to phrase this, with parties that, wanted to know Sinclair Range's experience, not just in the things that we do awesome, which is helping a company transition, refinance, restructure, turnaround operations, make more money, not just in that, but to do that in a public company environment. What's your public company experience? And my answer is, I don't really care. Plenty. We have public company experience, plenty of it. But I don't really care about the company being public or not public. What does public come down to at the end of the day for a distressed business? It comes down to a reporting function that's expensive and an anchor on the changes that you want to make, a regulatory function that is expensive and an anchor on the changes you're trying to make, and a restriction on the way that you go about your financing. That's what it comes down to. So you have handcuffs on. But it doesn't change the fact that you need to go off and make money, get your head down, create value, execute, and first principles, and create shareholder value. Now, I know many of you are going, Scott, wait a minute. It's not a handicap on how you raise money. It opens up other opportunities to raise money. We can sell some shares. We can get some liquidity, some free trade. That's all fine. And I think it absolutely used to be true. But I would suggest to you that at this point of the regulatory cycle, of the economic cycle, the retail market is not there. It's not like it's completely gone, but it's really difficult for a newco, for an acquisition strategy, for a tech deal. It's difficult to go to the retail market, do a reverse into a public company, and raise a bunch of funds. It's very, very difficult. And so I would suggest to you the public company brings more problems and expense than it creates opportunity. And so I would rather you were private, but if you're public, it doesn't matter. It doesn't matter. You have professionals, they deal with reporting. You have professionals, they deal with the regulatory. You talk to your lawyers about this deal or that deal. That's just a cost. It's just an expense. What matters if you're trying to grow value is that you execute from an operational and strategic perspective to focus on first principles. And that is my reminder lesson of the week for ourselves here at Sinclair Range. I was asked in one of those meetings this week, what would I do if we had all the money in the world at Sinclair Range and we wanted to grow? How would we spend that money? It's an interesting question, right? A good question. And it really comes down, I think, to jurisdictions. But I will tell you something, that in professional services firms, for the most part, what happens is there is a natural cap on the per partner or per professional earnings. So in other words, think of a law firm. You have 10 lawyers and it's a successful firm, and some partners make X and some partners make a fraction of that, 80% of X, but it's all kind of within a range depending on how their partnership compensation is set up. But it's generally within a range. And then if you want to grow your firm, we're going to go to 1,000 lawyers. Ironically, you can get bigger and bigger and you can create a stronger brand and all that sort of stuff. But the per partner income doesn't change that much. It does change, right? You have very large law firms where the partners are making way more money than they would be if they were on their own at a very small law firm. That's true, but it's all within a range. It's all within. You're not going to become a billionaire being a lawyer, right? You don't create that sort of value. So the question is, why? Why, as a professional, would you spend a bunch of money growing a professional services firm and creating the headache that goes with that without much income? Like people used to want to hire me often in my career, and through the predecessor firms to Sinclair Range, I'd be operating those, and then I'd get a call every now and then. It would be intriguing, and I would go to New York or Toronto and have an interview. And I ended up just telling people right up front, look, here's the deal. Even back in the 90s, I said, I could sit in my basement by myself in my underwear and I can bill 7 figures with really no expense. So if your compensation package is not exceeding that pretty significantly, why are we even talking, right? And that's what happens in a professional services firm. You grow and grow and grow, but you're not really making that much more money. There's a lot of brand power. There's a lot of ego, but that's the problem when you're growing. It's people and it's real estate. That's what it all comes down to, in my view, at professional services firms like law firms, accounting firms, and a boutique firm like Sinclair Range. So, having said all that, if we had all the money in the world, what would I do with that? Well, in the U.S., I think I would make exactly that mistake. I think I would build a very, very strong middle market professional services firm, because I think in the U.S., I have no data to back this up. I have not done a deep dive into the research, but my anecdotal view on this market is that you have really, really large professional services firm that charge more and more and more to try to up that per partner or per professional income, because that's a rat race. Like you need to make more money than you need to keep up with the Joneses, as they say, and you do that by charging more per hour, and they add less and less value to the client because it just becomes more bureaucratic. You become more risk adverse. You are less able to evaluate the risk of a particular situation in real time. That's what the bureaucracy does. And so you have these behemoths that I think are just charging way too much and don't add value. And then you have a highly fragmented number of shops in regional areas. And one of those might be just like Sinclair Range, that hopefully does find a way to get compensated in alignment with the goals of the client, and that generates a lot of value for the client. So I hope that Sinclair Range does that, and I think there's a number of shops in the U.S. that do exactly that, but they don't have the power of that national brand. I think there's a big hole there. And so I would work to do that. But in Canada, if the question was applied to Canada, I would not do that at all. I think Canada is a different market. I think it's dominated by the old brand name firms, both accounting and legal and banking. I think you could definitely spend a lot of money and hire people to build a professional services firm, but you're not really creating value because the goodwill and the value is with the professional and their name themselves. And the reason for that is Canada is a very small market, and so the goodwill's with the person. Everybody sort of knows everybody, or there's one or two only degrees of separation. And so what I would do in Canada is there's a desperate need, a desperate hole for a high yield private debt fund, an asset-based lender, a bridge lender. Everybody that was in this space has blown up. And one of the reasons they blow up is, for some reason, a lot of these funds have capitalized themselves with money that is marked to market daily and that is needs to be redeemed in real time. For example, it's in your mutual fund as a retail investor, and you say, oh, I'm going to put money into this private debt fund, and I can take it out anytime I want. Except when you go to take it out, the private debt fund has invested that money of yours in the pooled capital into a business at 13%, 15%, 18% paper, or much more if you're in the factoring business. And it's got a 12-month, 18-month, 24-month return. And you can write whatever month you want for the term on that piece of paper, but the fact is, the company's going to pay it back when the company's able to pay it back. Like that's just the reality of that business. And so you have illiquidity on the asset side and complete liquidity demands on the liability side. And as you can imagine, if things get a little lumpy, that ends up being trouble. And so many, or if not all, every single fund that I can think of in Canada of any significance has a ring fence around it, which means you can check out anytime you want, but you can never leave. And so that's what's going on in Canada. I think if you had a reasonable cost of capital and it was patient, you could deploy $1 billion, $1.5 billion high yield paper into this market in Canada, in mid-market and smaller businesses. I think you'd be safe. I think you'd make a fortune. I think it's been proven over and over and over again, and there's a real need for that. So I would have differing opinions, and that was my interesting conversation of the week. And along the ideas of this private debt fund, I would think that this is a good time to introduce to you Sapphire Global Investments, which is a new company, not owned by us, not controlled by us, but Sinclair Range has a deal. And when I say deal, at this moment it's a handshake. Things can change, but we're working on the legal agreements. They should be done next week, I think. And Sinclair Range will be the exclusive advisor to this brand new pool of capital. And we are looking for deals. Had a great call this morning on a deal that would be a private debt bridge loan type deal. We're looking for secured debt, bridge loans, equity deals, everything. We're looking for everything. And I will say that I personally sit on the investment committee for this new pool of capital, but I do not control it. Sinclair Range does not control it. This is somebody else's capital, but as a service, Sinclair Range is the financial advisor on this fund. So we're really excited about that. Love the people involved in SGI, the Sapphire Sapphire Global Investments. See, I don't even have the name exactly right yet. But we're excited about that, and that's going to help us. We're going to do a great job there. We will be making tons of return because there's just deals all over the place for this sort of fund. As I said, there's just this gaping hole in the Canadian marketplace. And so I think we're going to knock it out of the park. And it's also going to help grow Sinclair Range, which is the mission here, is it not? We took a loss. We took a loss this week and last week, more last week. One of our clients, McQuillan Meter Systems in Edmonton. This is public information now, so I could disclose. It was a 25-year-old business, about 20 employees, family-owned. Again, public information, banked by Royal Bank of Canada. In fairness to Royal Bank, they didn't bank the deal, really. It was an HSBC deal that was inherited by Royal Bank as part of the acquisition. The company owes Royal Bank about $3 million. So it's a small credit, small deal, small business, but a strategically very interesting business in the energy sector. Sinclair Range was engaged October 2024, so a year ago now. And we were brought in initially because the company just couldn't, it was up against it on the cash flow, but it also hadn't done any financial reporting in like 6 months. And so part of what we do is fractional virtual controllership services. So we took over the books and records. We got reporting. We were doing also turnaround advisory. And the idea was we all knew a year ago, we had to refinance Royal Bank because they wanted out. It was in special loans, and that was sort of one of the reasons that we were called. And the bank was cooperative and patient, and we started doing 13-week cash flows, which is a tool that I talk to you about all the time. And, the interesting thing about this situation is when we met them a year ago, they owed RBC $3 million. And today they owe RBC about $3 million. And never once have they materially gone over that number. In other words, there was never a significant panic phone call to RBC saying, we need a bulge. We need to go over our line of credit this week. And so that never happened. So the company, therefore, cash flows. That's evidence that the company cash flows. But the problem is, once we got the reporting going and we were able to go to market for financings, which would have been last winter, like past February, let's say March, in that area, what we found is that the security value for a new lender was not very good. So receivables come out to $800,000, $1 million. That's the margin number, not the gross number. And it's complicated because there's work in process billings and things in there that lenders don't enjoy. But mostly there's just way too much inventory at this company. And I'm gonna estimate that without disclosing any real information, that I think for the purposes of the discussion, well, let me put it this. I'm not even going to say that because I don't know that that information is public information. So I won't say that. But I will say that at the time, we could get a term sheet from a new lender for $1.5 million, not for the $3 million owed. So we're short. We're short $1.5 million. So we always thought, we being the company, had always told Sinclair Range, hey, there's an equity investor in one of our primary customers. They'll make up that difference. Long story short, they did not do that. And we were in forbearance at that point with the Royal Bank, and the forbearance ran out. And so we're not, they're unable to pay back the $3 million. I asked RBC if they wanted to take the $1.5 million. They said no. And so there we go. So we started a sales process, a sales investment solicitation process I've talked about on past episodes. That's the one that I was referring to, where we're going out to a bunch of strategic parties, financial parties, and saying, hey, this company's in a bit of trouble. Here's a process on a hurry up offense. We need to get people in the door, sign the NDAs, go through the data room, get some offers out of you, like in a matter of weeks. And the idea here is to generate as much cash as we can in a transaction, in a sale of the business, to pay off RBC the $3 million. And so that's what we were doing. Now, in truth, RBC did not sign on to that plan. Their plan, as communicated to us, is they just wanted to liquidate the business, which of course would give them much less money. But regardless, we act for the company, and our job is to do what we can. And at the end of the day, there's only 3 ways that I know of to pay off a bank. One is you refinance them if you don't have the cash handy. You refinance with somebody else. You sell the business, and part of the proceeds is to pay the bank, or all of the proceeds. Or you liquidate the assets and the bank gets what it gets. That's that's what you can do as a debtor. So regardless of what the bank's view was, it was our job to start this sales process, and it was going pretty well. And I won't bore you with the internal negotiations and all this stuff, but when it was time in the sales process for the non-binding letter of intent, think of it as like an expression of interest, comes through, we had 4 or 5, somewhere in that range, emails of people saying, hey, it's been really tight time frame. We're still working on this, but we're really interested. That was all disclosed to the bank and its professional team. And we had a letter of intent that said, hey, we'd like to buy this business for $4 million, 3 in cash, and $1 million in equity to the vendors, being the company owners, the family. And that's not the bank's business, but that's what the LOI said. And so it gets the bank out in whole. And so that was delivered on time. And in the course of doing that work, it's how Sinclair Range found Sapphire Global Investments, coincidentally. So that came from them. And the bank saw that. And were they happy? Were they happy that they were going to get $3 million closing in less than 30 days and get all their money back? Nope. Nope. Were they happy that 2 days before that, the same group through Sinclair Range said, hey, maybe we should just buy your debt and security RBC for $2.5 million? Nope. Nope. They weren't happy with that. They were non-responsive. They were dismissive. Not the bank itself. We are actually a good client at RBC. I like RBC. But through their professionals, they were dismissive, they were aggressive, they were derogatory. And so they turned down the 2.5, they turned down the 3 because we had no ability to enforce that. And instead, they went to put in a receiver. So that was last Monday, like a week ago last Monday, as I was arriving in Toronto. I said I was so busy. And so a receiver goes in, and now the receiver is calling and say, hey, let's do that $3 million deal. I want to talk to you. As if it's the same deal, as if the value of the company on a going concern is the same of a value in receivership. It's not even close. We spent a couple of days. We put in a new offer. We spoke to receiver's counsel because the receiver refused to talk to us. The bank doesn't want to talk to us. But receiver's counsel was professional and courteous, so that was all good. Spoke to receiver's counsel and told them who what is now called Sapphire is. They were happy enough with that. We put in, she said, hey, we need something this Friday. That was like 2 Fridays ago. Yeah, no problem. So we put it together and we sent them. Now it was draft. It was a draft. Here's where we're trying to head with an LOI. And it wasn't complete, but it was on time. And the number was 1 and 1.25. So we got like 2.5, 3. Now we're down to 1.25, but without the receivables. So the bank could have collected $2 million. And that seems to me, and you know, we would step in and start hiring back employees to do jobs at our own expense, things like that. An interim operating agreement is called. Did we get a reply? Nope. Yeah, well, we did. Thanks. Well received. We'll go look at it was basically the reply, and then nothing. Crickets. I had a deadline of this past Wednesday, like 2 days ago on it. Nothing. So Wednesday, I sent in a note saying, I guess you're not doing this. And we got a note back and said, it's not a firm deal. Obviously, it's not a firm deal. We sent you in a draft to see where we're at. And, never heard back from anybody. So they've said that they want to go into liquidation. I suspect that's exactly what is going to happen. I suspect that we may still want to buy this from the auctioneer. Obviously, it'll be a much, much lower price. We'll see. We'll see if we can build a business case out of that. So that's the struggle. That was the struggle for the week. What have I been thinking about? I've been thinking a lot lately of the inner circle deals in capital, deals and capital. The inner circle deals in capital. What is that, you might ask? The inner circle is a free, private, bi-weekly Zoom meeting. It's a live community where founders, entrepreneurs, executives, advisors, educators come together, like I said, every 2 weeks, and we pitch deals, share challenges, get feedback, and sharpen their strategies. The values of this are not necessarily like a pitch group to angels to raise money, but rather education and community building. And it's a relatively new initiative, not of Sinclair Range, but the brand The Scott Sinclair. You can go to look that up at thescottsinclair.com. And we're just knocking it out of the park the last couple of sessions. So this week, this past Tuesday, we had, I won't say his name on this forum because our inner circle is private, but we had a managing director and senior partner of a global consulting firm sharing insights on their idea to start up a private equity fund with a single holding to, in effect, do turnarounds, but not on financially distressed, but rather inefficient companies, and to become principals and to transition from a consultant to a principal, which was interesting. We had Greg Booth from Circular Industries. You can look them up on the internet. Circular Industries out of Victoria, British Columbia, that has wildfire fighting UAV systems, a drone-based rapid response for forest fire suppression. But suppression can also be used in urban environments. And Greg is a guy that I met I don't know, 6 months ago, 9 months ago, and he and his team were just formulating their thinking. And wow, have they come a long way. And I don't know that the Inner Circle or thescottsinclair.com and the content that you could find there has helped, but I think it might have. I think it really might have. And so that was just a terrific job by Greg doing that pitch. And I think he's picked up some very strong context as a result of that. Iron Horse Credit, Tom Harris out of Chicago came in, gave us a review of the Iron Horse Credit ABL product, what they're looking for, deal size, structure, all that sort of stuff. And so that was good. If you want to join the Inner Circle, it's free. You have to get past the gatekeeper, which is Ashley or myself, but it is free. Reach out to us in the notes on one of these shows and come join us. Come join us if you can. Thanks for listening. This has been the Sinclair Range Week in Review. That's all I have. Thanks to all of you that watch this content. You give great feedback. I've reached out in the DMs with questions and everything else. And if you are a business that is in transition, I don't care if you're high growth, distress, or you're just doing deals, Sinclair Range is built for you. Reach out to us and say hello. And I do hope that we get this show loaded up today. We'll see how the internet goes. See you next week.